All right, today we are diving into an absolute giant in the world of finance, a book that has literally shaped the fortunes of millions. Benjamin Graham's The Intelligent Investor.
And look, we're not just starting with my opinion, we're starting with some seriously heavy praise. When Warren Buffett, arguably the most successful investor of all time, calls a book by far the best ever written, well, you gotta pay attention. This thing is more than just a book. It's the bedrock of a whole way of thinking about money.
But let's be real, that raises a huge question. The book was first published way back in 1949. We live in a world of crypto, meme stocks, and AI-driven trading. So can a book that old, a book from a totally different era, really still be relevant? Is this dusty old text still the Bible for someone trying to invest today? That's what we're here to find out. To really get the book, you first have to get the guy behind it. So let's meet the mastermind himself, Benjamin Graham, a man often called the father of value investing. Now, Graham wasn't some academic just writing theories from an ivory tower. No, he was in the trenches. He was a wildly successful investor whose entire philosophy was forged in the absolute fire of the Great Depression. He saw what happens when markets completely implode, and that brutal experience taught him that the number one rule is protecting your capital. And this is the absolute core of his big idea, what we now call value investing. He realized the market isn't some perfect, logical machine. Nope, it's more like a moody pendulum, constantly swinging back and forth between crazy, irrational optimism and completely over-the-top, unjustified pessimism. The job of the intelligent investor? It's to use those swings to your advantage, not get swept away by them. And to explain this whole idea, Graham came up with this brilliant, powerful metaphor. So let me introduce you to your new and very, very volatile business partner, Mr. Market. So picture this. You're in business with this guy, Mr. Market. Every single day, he shows up and he quotes you a price. He's either willing to buy your share of the business for that price or sell you his share for the same price. Simple enough, right? Well, here's the catch. Mr. Market is, let's just say, emotionally unstable. Some days he's totally euphoric. The sun is shining, he's read some great news, and he'll offer you a ridiculously high price for your shares. But other days, he's a total wreck. He's depressed, convinced the world is ending, and he'll offer to sell you his shares for practically nothing. And here is the whole lesson. This is the key. Mr. Market is there to serve you, not to guide you. You are completely 100% free to just ignore him. You don't have to listen to his crazy offers. The intelligent investor doesn't let Mr. Market's mood swings dictate their decisions. You just wait, and you only act when his price is a fantastic deal for you. Now, Graham was smart. He knew that not everyone wants to spend their weekends reading annual reports. He didn't create a one-size-fits-all strategy. Instead, he basically said investors fall into two camps. So the question is, which one are you? Okay, so on one side, you've got the defensive investor. This is probably most people. Your main goal is safety, consistency, not losing your shirt. It's a low time commitment. And Graham's advice here was genius for its time. Just diversify widely, maybe using something like a low-cost index fund. Then on the other side, you've got the enterprising investor. This person is willing to put in the work. Their goal is to do some serious detective work, digging deep to find companies that are truly undervalued. Graham called these cigar butt stocks, thrown away by others, but still have one good puff left in them. All right, we've arrived at what is probably the single most important concept in the entire book. Seriously, if you take away just one thing, let it be this. This is the golden rule of investing. It's called the margin of safety. And it sounds fancy, but the idea is incredibly simple. Only buy something when it's on a big sale. You do your homework to figure out what a company is really worth, its intrinsic value, and then you wait. You only pull the trigger when the market price is way, way below that value. Let's make this super clear. Imagine you analyze a company and figure out its stock is worth about $100 a share. You don't buy it at 99 or even 95. You wait until Mr. Market is having one of his terrible days and offers it to you for, say, $60. That $40 gap, that is your buffer. That's your margin of safety. It's the cushion that protects you in case you made a mistake or if things just go wrong. And Graham's own words just nail this point. He said the real job of an investor isn't about chasing the highest possible return. No, it's about managing your risk of losing money permanently. If you get the risk part right, the returns will eventually take care of themselves. Okay, so let's circle all the way back to that first question we asked. We've got these powerful but, kind of old-fashioned ideas. How do they actually hold up in the wild, chaotic markets we all face right now?
Well, it turns out Graham's principles give you the perfect psychological toolkit for modern madness. That discipline he teaches, it's what helps you resist the FOMO, the fear of missing out, on the latest meme stock craze. Understanding Mr. Market, that's what helps you navigate the insane volatility of crypto without having a panic attack. And that margin of safety, that's what stops you from panic selling in a crash or from blindly piling into the latest AI hype at any price. And hey, if you need actual living proof that this system works in the real world over a very, very long time, you only need to look at Graham's most famous student.
Warren Buffett himself constantly says that Graham's principles are the bedrock, the absolute foundation of everything he's ever done. He built his entire empire on these core ideas, treating the market as your moody servant and always, always demanding a margin of safety. So let's be super clear about what this book is and what it isn't. This is not a get-rich-quick scheme. In fact, it's the exact opposite. You could call it a get-rich-slowly manifesto. It's a blueprint for building real, sustainable wealth over a lifetime by being careful, patient, and disciplined. So in the end, this book isn't really about picking stocks. It's a guide to mastering your own brain. It teaches you how to be rational when everyone else is panicking, how to be unemotional when everyone else is getting greedy, and above all, how to be patient. So the real question it leaves you with isn't just about investing. It's a challenge to yourself. Are you ready to become an intelligent investor?